Okay, so apparently you can sell way fewer computers, hike the prices, and still call it a massive win. Welcome to Earnings Unscripted. It's August 26th, 2026, and today we're looking at HP Inc.'s Q3 results, tickers HPQ.
A win on paper, maybe. But the underlying strategy is running pretty hot right now. They brought in just under $15.7 billion in total revenue this quarter. That's up roughly 12% year over year, which sounds like a fantastic headline until you look at exactly how they got there.
Right, because volume was actually down. I mean, they just squeezed more money out of the units they did sell, which makes me wonder why the tape looked so ugly after hours, because they comfortably beat the top end of their earnings guide, coming in at 83 cents a share.
Yeah, the stock had a very steady rally heading into the print and closed green during the regular session. But then it just gapped down hard in extended hours, dropping about 6%. And by the way, since we're talking about price drops, obviously it's just our personal take here and not investment advice. The sell-off happened because underneath that big headline earnings beat, the actual operational foundation's a little creaky.
Creaky how? Because they're hyping up this huge AI PC shift, and their commercial segment held up pretty well. They even have this fascinating story about using their own local AI workstations on their Singapore assembly lines to do visual quality control. It sounds like they're really practicing what they preach.
They're definitely drinking their own champagne. Playing the customer zero routine is a brilliant enterprise pitch. But the real issue, the structural problem right now is commodity costs. Memory and storage prices are absolutely eating their margins alive across the PC segment. And if you strip out a very specific regulatory windfall, that whole bottom line beat just completely vanishes.
Wait, regulatory windfall? I was looking at the adjusted numbers, but I definitely missed a regulatory trick. Are you telling me their quarter was essentially rescued by some random legal refund?
Rescued feels accurate. Back in February, the U.S. Supreme Court overturned some historical tariff collections. So, HP just booked 11 cents per share this quarter from estimated tariff refunds.
You're kidding! So that big bottom line beat is really just a rebate check in the mail?
Basically. Roughly 13% of their adjusted earnings isn't organic operational growth at all. It's retroactive luck. If you strip that refund away, their operating margins dropped exactly to the low end of their long-term guidance range. The CFO even lumped the regulatory win together with their actual business. Karen Parkhill said, quote, "Pricing, strong growth from our key growth areas, and tariff refunds partially offset these headwinds."
That's a wild combination to put in one sentence. It feels a bit like saying, my strict diet, plus finding cash on the sidewalk really helped me meet my financial goals this month.
That's exactly it. And the problem's that memory and storage costs keep inflating. They've got to pass that pain on to the consumer. But it gets even sneakier on the accounting side when you look at how they're defending those adjusted margins.
Okay, sneakier how?
Well, Bruce Broussard's still acting as interim CEO. The executive search keeps dragging on. On the call, he actually said, quote, "I am sure you can appreciate that I am unable to share details or a timeline, but the search is proceeding well and we continue to make good progress on finding the right next leader." But what they didn't mention loudly is how they're handling the retention and search costs.
Hold on. Walk me through that. You mean they're paying huge executive retention bonuses and just putting it below the line, like treating those payouts the same way you'd write down a close warehouse?
No, that's not quite it. It isn't a warehouse write-down, and it isn't normal stock comp either. What they're doing is taking the specific executive retention bonuses and hiring costs related to the CEO transition, and they've explicitly reclassified them into their non-GAAP restructuring and other charges.
Ah, right. So because they slapped a restructuring label on it, they don't have to count the friction of keeping executives happy against their adjusted operational profitability.
Exactly. It isolates the messy reality at the top, which mechanically inflates the adjusted margins compared to strict GAAP reporting.
That's pretty clever, but also slightly desperate, right? Because if commodity costs are spiking and you're manually adjusting out the executive churn, you're leaning
awfully hard on your pricing power to save the actual business.
Yep, which brings us to the core issue. They're telling customers to just absorb the inflated costs of these new PCs, while management openly warns that the fourth quarter revenue is going to be below seasonal because of that exact demand elasticity.
Meaning regular people won't actually buy the laptop if you hike the price too much, AI or no AI.
Right. They grew personal systems revenue 18% year over year, which sounds phenomenal on the surface, but actual unit volumes fell 16%. They're just selling significantly fewer computers at much higher average selling prices, mostly driven by those commodity hikes and a shift toward premium models.
Okay, so a classic less for more cycle. But how long can you realistically prop up an entire top line just by forcing aggressive price hikes onto a shrinking pool of buyers?
Honestly, probably not much longer. They're already projecting the broader PC market to decline in the high teens for the second half of the year. You eventually hit a ceiling where even enterprise buyers just delay their refresh cycles because the hardware's too expensive.
So you're saying this whole AI PC supercycle narrative might just collide with plain old budget fatigue?
Exactly. I mean, they're aggressively pushing the transition anyway. Management expects these AI PCs to jump to half their sales mix by year end and scale up to maybe 60 or 70% next year. Bruce Broussard essentially pitched this as an inevitability on the call, saying, quote, customers want local AI they can own.
Sure, but wanting it and actually stomaching a massive price premium right now aren't exactly the same thing, especially if you know the tech's going to be better next year.
That's the real risk here. And the CFO admitted the pain isn't over. The margin benefit from older, cheaper hardware inventory is basically gone. So Q4 is going to bear the full brunt of those inflated memory costs, which means margins haven't even troughed yet.
Wow. Okay, so it gets worse before it gets better. Did they offer investors any kind of silver lining to stick around through that trough?
Well, expecting another chunk of tariff refunds definitely helped their Q4 earnings outlook. But operationally, they raised their full-year free cash flow guide. They're now looking for roughly $3.1 billion at the midpoint.
Oh, I guess that's the ultimate reality check. The unit volume's heavily stressed, they still don't have a permanent CEO, and hardware margins haven't hit bottom. But if you can still spin off that much cash while navigating all of it, you're in a little patience.
That's right. Catch you next time.
If you want to catch these details before the market fully digests them, hitting follow in your podcast player is a great idea. And just to be completely transparent about our own tech stack, this entire show's synthetic and totally voiced by AI, letting us flip a dense HP earnings call into an episode on the exact same day. We're always taking suggestions, so send your ticker requests over to earningsunscripted@datamadness.ca or find the X link in the show notes.